In unpredictable times, the right decisions are crucial. Join us to master short-term business decisions and stay ahead. In this series of videos, you will learn how to evaluate special pricing orders, maximize revenue, minimize costs, make strategic choices for success. So subscribe now and hit the bell icon for essential insights. You are ready to start to equipping your business to thrive. Back to short-term business decisions. This is part 3 and also the last in this series. Again, the content in this video is designed for educational purposes and aims to enhance your understanding of accounting principles and practices. Always consult with a CPA or financial advisor for specific guidance tailored to your individual or business needs and circumstances. So we begin with learning objective 8.3. Make decisions about dropping a product, product mix, and sales mix. So how do managers decide which products to produce and sell? So deciding which products to produce and sell is a major managerial decision. If manufacturing capacity is limited, managers must decide which products to produce. If shelf space is limited in the stores, then managers must decide which products to display, which products to sell. Also, managers must often decide whether to drop products, departments, or territories that are not as profitable as desired. So let's look at how these decisions are made, beginning with some of the questions managers must consider when deciding whether to drop a product or a business segment, such as a department or territory or region. Dropping unprofitable products and segments. First, the manager evaluates whether the product or segment generates a positive contribution margin. It is essential to determine if the fixed costs will persist even if the company discontinues the product or segment. Additionally, the manager considers if any direct fixed costs can be avoided by dropping the product or dropping the segment. Another consideration is whether discontinuing the product or segment will impact sales of the company's other products. And then finally, the manager examines how the company could utilize the freed up manufacturing capacity or store space. We continue to follow the 2 key guidelines for special business decisions. Of course, the first is focus on relevant financial data and use a contribution margin approach. The relevant financial data include the changes in revenues and expenses. However, in this scenario, we are considering a decrease in volume rather than an increase, as we did in the special pricing decision. In the following example, we illustrate how managers decide whether to drop a product. The same process applies to decisions about discontinuing a business segment, such as a department or territory or location or region. Okay? Now, earlier, we focused on one of Smart Touch Learning's products, and we talked about the tablet, the standard tablet. Now, we will examine two of its products, the standard tablet and the premium tablet. Here in Exhibit 8.6, it presents the company's budgeted contribution margin income statement by product, assuming that fixed costs are shared between both products. Here in this middle column, where you see standard tablets, this is the income that you see here for the standard tablets. The third column here is for the premium tablets. The premium tablets. Okay, so this is the product line that has an operating loss, right? Operating loss of $5,000, prompting management to consider discontinuing the product. So the first question that management should ask is what? Does the product provide a positive contribution margin? That's the first question. Now, if the product has a negative contribution margin, it means the product is not even covering its variable costs, and the company should consider dropping it. However, if the product has a positive contribution margin, it contributes to covering some of the company's fixed costs. In Smart Touch Learning's case, the premium tablets provide a positive contribution margin of $90,000. Here it is right here. Therefore, the manager of Smart Touch Learning need to further analyze the fixed costs before they make a decision. Smart Touch Learning could allocate fixed costs in many different ways, and each way will allocate a different amount of fixed costs to each product. For example, fixed costs could be allocated using a traditional method with direct labor hours as the allocation base, by using activity-based costing, or by using some other method. However, in the short term, many fixed costs remain unchanged in total, regardless of how they are allocated to products or other cost objects. Therefore, allocated fixed costs are irrelevant, except for any amounts that will change because of the decision that is made. So what is relevant are these questions that you see here. Will the fixed costs continue to exist even if the product is dropped? The other question is, are there any direct fixed costs of the premium tablets that can be avoided if the product is dropped? So let's examine where fixed costs will remain unchanged. These fixed costs, which will continue to exist even after a product is discontinued, are often referred to as unavoidable fixed costs. Unavoidable fixed costs are irrelevant to the decision because they will not be affected by whether the company drops the product or not. Assume that all of Smart Touch Learning's total fixed costs of $321,000 will persist even if the company discontinues the premium tablet. Also assume that Smart Touch Learning manufactures the premium tablets in the same plant using the same machinery as they used with the standard tablets. Therefore, only the contribution margin from the premium tablets is relevant. If Smart Touch Learning drops the premium tablets, it will lose the $90,000 contribution margin. Remember, we talked about the differential analysis? That was back in Exhibit 8. What was it? Anyway, in this exhibit here, it does show a loss, right? If Smart Touch Learning drops the premium tablet, revenue will decrease by $230,000, but variable expenses will decrease by only $140,000, resulting in a net $90,000 decrease in operating income. Since fixed costs are unaffected, they are excluded from the analysis. Notice here that the decrease in operating income is equal to the contribution margin for the premium tablets. You remember the $90,000? In different analysis, items are shown with their impact on profits. The decrease in revenues will reduce profits, so it is shown as a negative amount. The decrease in costs will increase profits, so it is shown as a positive amount. So this analysis here, it indicates that management should not discontinue the premium tablets. In this next scenario, instead, assume that Smart Touch Learning manufactures the premium tablet in a separate facility. Okay, assume that they're using two different facilities, one for the standard tablets and another facility for the premium tablets. So if they're using a separate facility, if the product line is dropped, the lease on that facility can be terminated, and the company will be able to avoid all fixed costs except $3,000. In this situation, $92,000 of the fixed costs belong only to the premium tablet product line. That's the $95,000 total fixed cost minus the $3,000 unavoidable fixed costs, which will give you the $92,000 avoidable fixed costs. Now, these would be direct fixed costs of the premium tablets only. Therefore, $92,000 of fixed costs are avoidable fixed costs and are relevant to the decision because this would change or go away if the product line were dropped. In Exhibit 10.8, Chapter 10, you'll see that in this situation, operating income will increase by $2,000 if Smart Touch Learning drops the premium tablets. Now, revenues will decline by $230,000, but expenses will decline even more by $232,000. The result is a net increase to operating income of $2,000. This analysis suggests that management should drop premium tablets. Other considerations. Management must also consider whether discontinuing a product or a segment would negatively impact the sales of other products. In the previous examples, we assumed that dropping the premium tablets would not affect Smart Touch Learning's other product sales. However, let's consider a grocery store. Even if the produce department is not profitable, would managers eliminate it? Probably not, because they would lose customers who prefer one-stop shopping. In such cases, managers must also factor in the potential loss of contribution margin from other departments affected by the change when deciding whether to drop a department. Another example is a company that manufactures dining room tables and chairs. Okay. Now, if the company stopped making tables, it would likely impact the sales of chairs, as customers often want to purchase matching sets. So management should also consider to evaluate how they could utilize their freed manufacturing capacity. In the initial Smart Touch Learning example, we assume that the company produces both standard tablets and premium tablets using the same manufacturing equipment. So if Smart Touch Learning discontinues the premium tablets, could the company manufacture and sell another product using the freed machine hours? Is there sufficient demand for Smart Touch Learning to produce and sell more standard tablets? Now, managers should consider whether using the machinery for a different product or expanding existing product lines would be more profitable than contributing to produce premium tablets. So let's summarize here. When considering whether to drop a product or segment, we go to the decision rule. If the lost revenues exceed the total cost savings, do not drop the product or segment. And if the lost revenues are less than the total cost savings, drop the product or segment. Companies do not have unlimited resources. They do not have unlimited constraints that restrict production or sale of a product. And it can vary, okay? For a manufacturer like Smart Touch Learning, these constraints might include labor hours. It may include machine hours or available materials. For a merchandiser or merchandising company, the primary constraint could be display space. Okay, display space. Other companies might be constrained by sales demand, where there are stiff competition that will limit the number of units they can sell. In such scenarios, the company produces only as much as it can sell. However, if a company can sell all the units it can produce, the question becomes, which products should it prioritize and increase production for? So, when facing constraints, companies consider these questions. One, what constraints prevent the company from producing all the units it can sell? Which products offer the highest contribution margin per unit of the constraints? And the third question that comes to mind is, would emphasizing one product over another impact fixed costs? So by answering these questions, companies can make informed decisions about how to allocate their limited resources effectively. So let's return to our Smart Touch Learning example. Assume that the company can sell all the standard tablets and all the premium tablets it produces, but it has only 19,500 machine hours of manufacturing capacity, and the company uses the same machines to make both types of tablets. So in this case, machine hours is constraint. Note that this is a short-term decision because in the long run, Smart Touch Learning could expand its production facilities to meet sales demand if it made financial sense to do so. Okay? In this exhibit here, it suggests that premium tablets are more profitable than standard tablets. Because the premium tablets have a higher contribution margin per unit and a higher contribution margin ratio. Here's the contribution margin per tablet. Standard has 192.50, and the premium tablet is 225, which is higher. The contribution margin per tablet is higher, and also the margin ratio is higher for the premium than it is for the standard. However, an important piece of information is missing: the time it takes to make each product. Assume that standard tablets require 7.5 machine hours to produce, and premium tablets require 10 machine hours to produce. The company will incur the same fixed costs either way, so fixed costs are irrelevant. Now, which product should it emphasize? Well, to maximize profits when fixed costs are irrelevant, the decision rule is to emphasize the product with the highest contribution margin per unit of the constraint. Because machine hours is the constraint, Smart Touch Learning needs to figure out which product has the highest contribution margin per machine hour. Here in this exhibit 810, it illustrates the calculations for the contribution margin per machine hour for each product. As you can see, standard tablets have a higher contribution margin per machine hours, which is the $25.66, than the premium tablets, which has only $22.50. So Smart Touch Learning will earn more profit by producing standard tablets. Why? Because even though standard tablets have a lower contribution margin per unit, Smart Touch Learning can make more standard tablets than premium tablets in the 19,500 available machine hours. That's why. Here in Exhibit 811, where it shows the total contribution margin with machine hour constraint. It proves that Smart Touch Learning earns more total profit by making standard tablets. $500,000 compared to $438,000. So multiplying the contribution margin per machine hour by the available number of machine hours shows that Smart Touch Learning can earn $500,370 of contribution margin by producing only standard tablets, but only $438,750 by producing only premium tablets. So let's re-examine our second assumption. Initially, Smart Touch Learning had budgeted sales of 2,400 standard tablets with the capacity to produce 2,600. Now, suppose a new competitor has decreased the demand for Smart Touch Learning standard tablets, and the company now expects to sell only 2,000 standard tablets as
compared to 2,400. So in this scenario, Smart Touch Learning should produce only as many standard tablets as it can sell and use the remaining machine hours to produce premium tablets. And here you're seeing the exhibit 811, okay, where it shows the standard tablet and the premium tablet total contribution margin at full capacity. The previous illustrations focus on production constraints for a manufacturing company. Merchandising companies also have constraints, and display space is the most common one. Merchandisers are constrained by the size of their stores, and managers must choose which products to display. Here in this scenario, Bride Company operates gift shops in airports and has only 48 linear feet of bookshelves in each store. The following chart shows the average sales price, cost of purchasing the books, which is a variable cost, and the contribution margin for hardcover and paperback books. So given that Smart Touch Learning standard and premium tablets require the same amount of shelf space, we're considering this company here that I just read about, Bright Company. It is a fictitious business operating gift shop in the airport. Now, these airport gift shops are relatively small, as you know, and Bragg has only 48 linear feet of bookshelves in each store. So fixed costs remain unchanged regardless of the products displayed. Based solely on the information presented, it is clear that hardcover books have a higher contribution margin and should be prioritized. However, managers must also account for the constraint of limited shelf space when making their decision. So the management at Bragg has determined that each linear foot of bookshelves can display either 10 hardcover books or 20 paperback books. According to the decision rule for the constraints, the focus should be on the product with the highest contribution margin per unit of the constraint. And here in Exhibit 13, the total contribution margin with display space constraint, it illustrates the total contribution margin given the display space constraint. So based on this scenario, based on this analysis, of course, the company, Bragg, can generate more profit per foot of shelving by displaying paperback books. Therefore, the company should prioritize paperback books. And most bookstores or gift shops in the airport, they normally will have more paperback books. But in this scenario, Bragg must also consider market preferences. What do airport shoppers prefer? Since Bragg can display twice as much paperback books as hardcover books, will the increased variety of titles boost sales and inventory turnover? Conversely, will Bragg lose sales if only paperback books are displayed? So these are additional factors that must be weighed when making sales mix decisions. Learning objective 4. And this is the last objective. Making outsourcing and processing further decisions. How do managers make outsourcing and processing further decisions? Now let's consider some short-term management decisions regarding how products are produced, such as whether the company should outsource a component of the finished product or sell a product as it is or process it further. Short-term management decisions include how products are produced. The two questions are, should the company outsource a component of the finished product or make it? Or should a company sell a product as it is or process it further? Many companies choose to outsource products, and they also outsource services. For example, a hotel chain. A hotel chain may outsource its reservation system. Now, this allows the company to concentrate on its primary function, which is serving the needs of its guests, rather than purchasing and operating an extensive computerized reservation system. So, by outsourcing, the hotel chain is taking advantage of another company's expertise, which allows it to focus on its core business function. Now, outsourcing decisions are often called make or buy decisions because managers must decide whether to buy a component product or service or produce it in-house. So the heart of these questions or the heart of these decisions is how best to use available resources. Smart Touch Learning is deciding whether to make the casing for its tablets, computers in-house, or should they outsource it to this company called Crump Casings, which is a company that's specializing in producing casing for computers, cell phones, and other electronic products. So Smart Touch Learning cost to produce 2,400 casings is $23 per casing. Crump Casing, the company, offers to sell Smart Touch Learning the casing for only $21 each. So the question is, should Smart Touch Learning make the casings or should they buy them from this company? Again, Smart Touch Learning, $23 cost per unit to make the casing is $2 higher than the cost of buying it from Crump Casings. Initially, it seems that Smart Touch Learning should outsource the casings, but the correct answer is not so simple. It's not so simple because manufacturing unit costs contain both fixed and variable components. In deciding whether to outsource, managers must assess fixed and variable costs separately. Smart Touch Learning must consider its opportunity costs. And what is an opportunity cost? It is the benefit given up by choosing an alternative course of action. And some of the questions managers must consider when deciding whether to outsource include: 1, how do companies' variable costs compare to outsourcing costs? 2, are any fixed costs avoidable if the company outsources? And the third question is, what could the company do with their free manufacturing capacity? When purchasing casing, Smart Touch Learning can eliminate all variable manufacturing costs, including the $15,600 in direct materials, $7,200 in direct labor, and $13,200 in variable manufacturing overhead. Now this totals to $3,600. I'm sorry, $36,000 in savings, or $15 per casing, which is 36,000 divided by 2,400 casings. However, outsourcing incurs a variable cost of $21 per unit, amounting to $50,400 for 2,400 casings. Now, based solely on variable costs, manufacturing in-house is cheaper, but fixed costs must also be considered. Assume that Smart Touch Learning cannot avoid any fixed costs by outsourcing. In this scenario, the fixed costs amounting to the $19,200, it remain unchanged and are irrelevant to the decision. Therefore, Smart Touch Learning should continue manufacturing its casing in-house, as the variable cost of outsourcing, which is $50,400, is higher than the variable cost of in-house production, which is $36,000. Consider the scenario where Smart Touch Learning can avoid some fixed costs by outsourcing casings. Suppose management can reduce fixed overhead costs by $12,000 through outsourcing. In this case, the company would still incur $7,200 of fixed overhead, which is the $19,200 minus the $12,000, if it outsources the casing. Okay, so the company would still incur the $7,200 of fixed overhead if it outsourced the casing. Here, the fixed cost becomes relevant to the decision because they differ between alternatives. Here in 816, you'll see the differential analysis for outsourcing decision when fixed costs will change. Our decision rule for outsourcing is what you see here. If the differential costs of making the product exceed the differential cost of outsourcing, then the company should outsource. On the other hand, if the differential costs of making the product are less than the differential cost of outsourcing, then the company should not outsource. We have not considered what Smart Touch Learning could do with the freed manufacturing capacity would have if it outsourced the casings to this other company. The analysis in Exhibit 10, Chapter 10, you'll see that later, assume that there is no other use for production facilities if Smart Touch Learning buys the casing from Crump Casing. But suppose Smart Touch Learning has an opportunity to use its freed up facility to make another product which has an expected profit of $30,000. Now, Smart Touch Learning must consider its opportunity cost, which is the benefit given up by not choosing an alternative course of action. So in this case, Smart Touch Learning's opportunity cost of making the casings is the $30,000 profit it gives up if it does not free its production facilities to make the new product. Smart Touch Learning managers must now consider three alternatives. One, use the facilities to make the casings. Two, buy the casings and leave facilities idle, continue to assume $12,000 of avoidable fixed costs from outsourcing casings. Or 3, buy the casings and use facilities to make the new product, continue to assume $12,000 of avoidable fixed costs from outsourcing casings. The alternative with the lowest net cost is the best use of Smart Touch Learning facilities. In this scenario, Smart Touch Learning should buy the casings from Crump Casings and use the freed manufacturing capacity to make the new product. If Smart Touch Learning makes the casings, or if it buys the casings from that company, Crump Casings, but leaves its production facilities idle, that Smart Touch Learning will give up the opportunity to earn that additional $30,000. So Smart Touch Learning managers should consider qualitative factors as well as revenue and cost differences in making their final decision. For example, Smart Touch Learning's managers may believe they can better control quality by making the casings themselves. Now, this is an argument for Smart Touch Learning to continue making their casings. So, sell or process further. So at what point in processing should a company sell its product? Many companies, especially in the food processing and natural resources industries, they face this type of business decision. Now, companies in these industries process raw material like milk, corn, livestock, crude oil, or lumber, to name a few, to a point before it is saleable. For example, a dairy processor pasteurizes raw milk before it is sellable or saleable, right? They have to pasteurize it before they can sell it. So the company must often decide whether it should sell their pasteurized milk as is, or should they process it further into other dairy products such as reduced fat milk? Should they process it into butter, sour cream, cheese, or other dairy products? So some of the questions managers must consider when deciding whether to sell as is or process further are: 1, how much revenue will the company receive if it sells a product as is? Another question, how much revenue will the company receive if it sells a product after processing it further? And another question is, how much will it cost to process a product further? These are just some of the questions managers must consider. Consider one of Smart Touch Learning's sell or process further decisions. Let's consider Smart Touch. Now, suppose Smart Touch Learning can sell its tablet computers as is, or add front accessible USB ports to the tablets. Now, the cost to add a USB port is $5. This cost includes the cost of the modified casing, it includes the cost of the USB component, and of course, it includes the labor to add this component. Now, this feature is very popular with customers, and tablets with this feature sells for $20 more than tablet without the feature. So here you see in Exhibit 18, it shows the differential analysis for sale or process further decision for Smart Touch Learning. You have the expected revenue. Well, in the first column you see is sell. This middle column, process further, and third column is the difference. So expected revenue from selling 24 tablets at $500 is 1.2 million. Okay. Now, if you want to process it further by adding up those other features, of course, the price of the tablet goes up by $20. So to process it further, you're looking at 1.248. Okay, and the difference of that is $48,000. And additional costs of processing at $5 more, would be a negative $12,000. Okay. So in this exhibit, it shows the joint costs. So by analyzing only relevant costs, managers see that they can increase profit by $36,000 if they add the USB port. The $48,000 additional revenue outweighs the additional $12,000 cost of extra processing. So what are joint costs? Joint costs are costs of a production process that yields multiple products. So in this case, the multiple products are the tablets without the feature and the tablets with the feature. Okay, so joint costs are also sunk costs. Smart Touch Learning has incurred the joint costs regardless of whether it sells the tablet as is or processes them further by adding the additional accessible USB port. So therefore, the joint costs are not relevant to their decision. So we go back to the decision rule, sell or process further. If the additional revenue from processing further exceeds the additional cost of processing further, then the company should process further. If the additional revenue from processing further is less than the additional cost of processing further, then the company should sell as is and do not process further. And this is the end of the series on short-term business decisions. So as we conclude the series on short-term business decisions, I want you to remember that these choices, while immediate, can have lasting impacts. Okay, so balancing quick gains with long-term strategy is key to sustainable success. Again, thank you for engaging in this journey with me, and may your decisions be informed and effective. Until next time.
Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.